Well, hey there, traders. Andrew Baxter here, and welcome to this week's edition of Investment News, our weekly advisory and newsletter service brought to you by Australian Investment Education and Money in Investing podcast. Today is Thursday, July the 8th, and let's get stuck straight into it. Of course, the usual, we are licensed and qualified to be talking with you. Past performance, no guarantee of future performance. And trading and investing does, of course, involve a level of risk. I'd also argue, as always, that the biggest risk of all in life is doing nothing and hoping that something changes. So let's get stuck straight in. A couple of things to wet your whistle. A couple of trades we've closed out this week. Oracle, you would have no doubt heard of in the US. Mini V8 strategy, this one a little bit aggressive. Profit 80% over 21 days, and we closed out of that this week. So nice to have that one in the bank for our clients. And why am I sharing this with you, given it's already happened? I guess more than anything is to validate and vindicate the process that we use here at Australian Investment Education. Another one for you, CMCSA. This is Comcast, again in the US. V8, another strategy we like to safely apply leverage as compared to using leveraged instruments such as CFDs or margin lending. Another 37% bank there over 28 days, and again closed this week. Third one for you here, Medibank Private here in Australia. Just a simple directional play, 27% profit banked in 26 days. Happy days, clients are happy, as you would be, I'm sure, if you were on these trades. So how do we pick these? As always, there is a process behind it. When the process is right, the results always follow. So we're going to run through this format as we do each week. Big picture, fundamentals, and technicals in order to give us, if you will, the trifecta of factors that we are really looking for. So first up, let's take a look at some of the big things in the US, and we're approaching results season. Actually, corporate reporting in the US, very different to Australia, happens quarterly, and in Australia it's every 6 months. And as a consequence, this really is a really significant factor for markets, because as you'll see in just a moment, I'll bring up a chart and show you this. Markets actually haven't been that volatile recently, and that may feel a little removed from the experience perhaps you've had if you're in markets, or again, if you're someone that's on the sideline and you're looking to learn about this. Volatility can be a terrific asset to your investing strategy, but you've got to be using the right strategies in order to achieve that. What we're likely to see here, I think we're going to see some pretty strong numbers coming out of this reporting season. Last time round, I think 67% of US companies that reported exceeded analysts' expectations, and I would expect that to be a trend that we see continue this time around. What I think will be a little bit more interesting is the guidance that will be provided by these companies, because what we're starting to see are some very early indications. It's priced in looking at the bond market, and we'll talk about that in the fundamentals in a few moments, that the US economy appears to be slowing down a little bit. And it's not surprising. I mean, the amount of stimulus that's gone in there, it's been firing on all cylinders, and just seeing that pause as things start to slip into play and get bedded down is not unusual. You've got to remember too, I mean, 850,000 new jobs created in the US last month based on the non-farm payroll figure that came out on Friday night. Just think about that, 850,000 new jobs. But unemployment, there's still around about 8 million people, 5.8% I think the US unemployment rate is at the moment. There's about 8 million people that currently are not back into the workforce that were actually working in the economy prior to the COVID virus slowdown there. So there's still some slack to be taken up. Something's a wild card, and I guess seeing the term wild card next to the name President Trump probably comes as no surprise. But today President Trump announced the commencement of and filed litigation against the big social media providers, Facebook, Google, and Twitter, as well as their respective CEOs. And this was a really interesting move. As to what the impact is likely to be on markets, we'll see in just a few moments. But talking of this, the issue, I guess, and the approach being taken is the First Amendment right to freedom of speech. The flip side to this, of course, is that all three of the aforementioned companies are private companies, and they don't have an obligation to provide a platform for individuals. It's a private company. They can pick and choose who they want on there. It'll be very interesting to see how that litigation proceeds, and we'll talk more about that, I'm sure, over future weeks. So let's take a look now into the charts and get a bit of a feel for what's going on. And we'll start off with the exploration of volatility, as I explained. So what we can see here is the volatility index, and it's interesting that you actually can trade volatility as well, which is something that's important to note as you move into more advanced styles of trading. One of the things that you can see is a reasonable decline over the last 6 months or so in volatility. We're back at these levels of 15. We haven't been down there for around about 18 months. And what's always interesting to see when volatility is low, it means options premiums are also low. So it's a great time to be buying long-dated options. It's pretty cheap to do that. And this is part of our strategy from time to time to capitalize on this. What we're looking for are these spikes that you can see adorning this overall index. And oftentimes they can be caused by economic statistics. This one back here, for example, was when the US inflation figures came out a little bit more than what people were expecting to see. But typically you see a spike in volatility going into a reporting season. So yeah, volatility is very low right now. There's a lovely trade in there if you've got the advanced skill set to be able to take that, to trade that pop as it comes through. And I'm sure that's one that we'll put on the silver platter for our clients. Taking a look at the broader market, let's start with the S&P 500. So as you can see, this is an index here which covers the top 500 companies in the US, the big caps. And you can see this is absolutely roaring right now, and it has been for an awful long time. Yeah, the US economy is in gear. There's been so much stimulus that's been thrown there. I think what we're starting to see is the emergence, and this is one that I've been watching very, very closely. We just had a recently closed out trade, and I think there's probably another one in this, say Starbucks as an example, which continues to benefit from the opening up of that economy. The vaccination program in the US, over 50% of people now, of course, being vaccinated compared to just we've broken the 10% milestone here in Australia. And that's really reaping dividends for that US economy because people are getting out and about, and it is giving them the ability to tap in again to more service-related business like Starbucks, which, whilst people were in lockdown, has certainly suffered. You wouldn't think that looking at the way the share prices perform, but this little run-up we're seeing here is something that we called for our clients last about 2 weeks ago now in our midweek hump day classroom. The banks are the first sector to report, and the likes of Wells Fargo and JP Morgan, Morgan Stanley, and so on, all looking to report. These have come off the boil just a little bit recently. It'll be very interesting to see what their guidance then looks like going into the next quarter, but I do feel there's further opportunity in these because just like in Australia, and we'll talk of the Australian banks shortly, the banking sector is a very, very good proxy for the backbone of the economy. If you're looking more on the investment banking side, and we'll talk a little bit about some corporate actions, particularly in the Australian market, then stocks like Goldman's are very, very well positioned for that. But all of these guys are reporting over the next week. Expect to see some movement there. Now, just looking at the NASDAQ, of course, is typically laden with technology stocks, NASDAQ 100. Again, that's also been on an absolute tear. Reflecting the recovery in a lot of these businesses. Netflix, for example, very interesting one where the competition that's coming under from Walt Disney company, weighed fairly heavily on the business, but it's been a big beneficiary through the COVID period, and again getting off the ground at 490, putting on a nice easy 10% in just literally a matter of 10 days in this market shows you how much these stocks can move. The litigation from President Trump or former President Trump, Facebook sort of had a bit of a stutter step last night. It'll be very, very interesting to see how they deal it. They haven't commented on this yet, but certainly it'll be interesting to see whether or not they take it in their stride, which I'm sure they will. But this tech sector, is likely to continue moving forward, although the big risk is inflation and that ability of inflation to eat away at future returns. And if inflation continues to push higher, particularly in the US, it will weigh some on the technology sector. Let's return now to the Australian market and take a look at a couple of the key headlines here. So looking at the Australian economy now, we've had a bit of a pause in our market. We've had a particularly strong run over the last 12 months or so, and the banks have been at the forefront of that, as we'll see in a few moments. And one of the really interesting ones, there's been a lot of corporate activity over the last sort of 2 to 3 weeks. Woolworths, for example, divested itself of its alcohol and liquor business. Telstra is selling its towers. Sydney Airport subject to competing now takeover bids. Crown running the wrath of the Finkelstein report in terms of its gaming license, of course, in Victoria. and AMP divesting itself of its capital management group. So massive amount of corporate activity amongst some of our bigger companies over the last 10 days or so. Also, I think a little bit of weight on the market is that interest rate uncertainty. We're starting to see signs that the Reserve Bank, are wavering on their view that they wouldn't raise rates before 2024. We're now hearing that it's not about dates, it's about data, which I would suggest is code for, we kind of got that wrong and shouldn't have made the promise. Look out, if economic statistics continue to support a rate rise, it will happen, and that is a massive risk for the property market. Also, further COVID lockdowns, as we've seen, particularly in New South Wales. And these are likely to be a bit of a wild card for us too, insofar as the economic impact of those is huge. And as long as, I guess, people, it would seem on the surface at least, aren't taking things that seriously as far as lockdowns concerned, and particularly when you compare the latter lockdowns in Victoria, where people have just about had enough of it, so they're doing everything they could to comply to get themselves out of that. At the moment, looking at some of the media footage in Sydney, doesn't seem to be the case there, and I suspect that may elongate that process, which of course weighs very heavily on the economy. Let's look at some charts, guys. So we'll start off looking at the top 200 companies here in Australia, and you'll see what I mean in terms of a little bit of a pause for breath. We've been on an absolute tear for about 9 months in this market, and this pause up here, this all-time high, and like any time when you get an all-time high, you're going to get a bit of a pause. We've had a pullback to this sort of halfway mark, and we're starting to try, as we saw today, to make some inroads higher. It's going to be heavy lifting because you do need solid, strong economic figures and, of course, strong company performance to move the needle on the index, which we're looking at here. So let's take a look at that now. CBA would be a very good example of one of the clear leaders within the banking space, but you can see its decision, another corporate action there too, by the way, selling off its common shore business, and you can see that it's now sort of sub 100, was up just over the $105 mark, but sub 100 there at the minute, and really is pausing for breath. And I think CBA has been my preferred banking play this year, but that allegiance has started to move for me in favor of, say, the NAB. And the reason I like the look of NAB, it's a significantly cheaper stock, about quarter the price. But the real issue here is that NAB has a little bit more exposure to business banking, which I think ultimately, as our economy continues to hit its strides, will be an area that performs well. I did mention about a couple of corporate actions. If you take a look at Woolworths and how Woolworths has responded, as you can see here, just get rid of that trend line on there so you can really see the full misery there. Not that you'd need to be reminded of it if you're a Woolworths shareholder. Yes, there'll be a capital return for investors, I'm sure, out of that, but the market's digesting that information right now. Sydney Airport, if you want to look at the opposite, on that takeover bid earlier in the week, it's really flown along. We've actually had a trade running on Sydney Airport, which has obviously been good for our clients. So plenty going on in this market. And here's the key thing: there always will be opportunity, simply because of the way that markets operate. Every day there are plenty of opportunities for investors to get onto. The processes that we use, technicals, fundamentals particularly, give us a good blend, if you will, so that when we plant the flag, we can do so with an awful lot of confidence. And this has never been more important than in the current market, where whilst the charts tell a story, the underlying fundamentals behind the business are almost more important right now, as we're in a stage of the market which is very fickle and not driven by news per se, but certainly driven by sentiment. And that's why we blend these together in the way that we do. So that's given us a quick hurtle through markets over the last period of time. I've got a trade feed out to look at. This one is on a company called Suncorp Metway. Suncorp is in the banking and finance space. Nice little breakout happening up here, as you can see from this morning, where it's really working to push higher than its previous highs back at the back end of June there. And if you're someone that's looking for income, let's flick across and have a look and see what income is available there. So the strategy that we use is a strategy we call cash flow on demand. And cash flow on demand is all about generating income. So looking at Suncorp, about 11.38 at the moment. So the income play on this is 23 cents per share, which has got 42 days to run on it. So effectively, you're selling 42 days of time. You're going to get paid 2% up front for that. And this is a meat and potatoes trade. This isn't one that's trying to shoot the lights out. It's just a regular cash flow on demand type trade. Now, 2% over 42 days doesn't sound that exciting, but annualized, that's nearly 17.5%, which is a damn sight higher than what you're going to get out of pretty much any asset right now. Just looking at the Sydney property market, which of course has been extraordinary in terms of the run that it's had pre this lockdown. A typical investment property there, $1 million apartment in somewhere like Elizabeth Bay or Wallara, is going to be generating you about 2.5% per year in terms of your income. Okay, there may be some capital move, but that's a question mark as to whether it goes up or down. The income, the guaranteed side of it, just about 2.5% per year, not 2% for just over the month. This one's an interesting one because there's a little bit more cream on the cake, and so your maximum potential upside here is actually around 3.1% for 42 days. Nice little meat and potatoes trade, that one, and that's a nice live one for you too. So the strategy that we use to capitalize on that is cash flow on demand. It's our flagship strategy. If you haven't taken a look at this, I can't encourage it enough. We're really focused on risk management with this, which is why it's served our clients so well over the last 12 months. In fact, over the last 20 years, what we've been using this, but particularly through the trauma that we've seen in markets through COVID, the correction that came, and then the recovery that bounced afterwards. So this is a strategy that's really stood up very well under the current market conditions. If you want information on that, I'd suggest go to our webpage, Australian Investment Education, and that's a .com.au, of course, being here in Australia and obviously holding an Australian financial services license. And click on there to get started. You'll see there's plenty of links there, and we'd love to better walk you through it. Just another thing for you, just to help you pad out your kit bag. If you haven't subscribed to our podcast yet, Money and Investing with Andrew Baxter, I'd highly encourage that. Some terrific free content for you there, which will continue to help you build out your kit bag and be in a position to really capitalize on where these markets are. And when you look at some of the trades that we looked at the start, Comcast, Oracle, and Medibank, terrific returns there for our clients, and there's absolutely no reason why we can't help you do the same thing. That's us for this week. Look forward to joining you next week, and keep the hard hat on through this earnings season, and we'll speak soon.